Good day, everyone. Welcome to Economics Wise. Our course for today is microeconomics, and our topic is market structure. Course guidelines for today include market, price taking and price making firms, type of market structure, perfect competition, features of perfect market. Starting from market, I'd like to explain that when you talk about a market, the first thing that comes to your mind is simply a place, a point of interaction. But in simple terms, the world has gone digital today, and market is just any system that facilitates transaction and the exchange of goods and services. Quite simple, right? The next on our list is the invisible hand mechanism. Like here, you'll be thinking, what does invisible hand entails in the economy like? But the invisible hand simply explains a metaphor for unseen forces that moves and drives the economy. What moves and drives the economy is simply the interplay of demand and supply in the economy that causes the natural movement of prices and also the flow of trade. Revenue is the receipts for the sales of product or the remuneration received for the sales of our output. Price taking firms. We say price taking firms are firms that has no significant control or influence on the prices of goods and services. However, they only have control on the quantity they produce. Price making firms are firms that has control on the prices of goods and services and also the quantity of goods and services. And an example of price making firms, we have the monopoly and monopolistic competition. Economic profits to and simply explains the excess of total revenue over total cost. However, this total cost simply takes into consideration your explicit cost and your implicit costs. To an accountant, he only understands the concept of explicit cost while computing his total cost. However, as an economist, we take into consideration implicit costs, and these are indirect costs that are not usually computed. An example of this cost would be entrepreneurship. Why should you, as an individual, not take into consideration your payment? For every business, you need to pay yourself first. However, we take into consideration this foregone cost. Normal profit is a break-even point between your total revenue and total cost, where there is no profit and there is no loss, but there is break-even. On the next slide, we have perfect competition. And from the word perfect competition, it simply shows the competing arrangement between people in a market scenario. However, I'll be explaining this based on the features we have listed. And the first is the free entry and exit. In this type of market system, there is free entry and free exit. A buyer can enter, sell, and it can also freely exist the market. The next is homogeneous products. In a perfect competition, there's homogeneous products because these products are usually standardized and they are identical. There's no form of differentiations in the product. It's of the same quality, it's of the same product, it is homogeneous. Another feature of a perfect competition could be buyers have a perfect knowledge and information of the market. They have a perfect knowledge about the technical conditions of the market. They have a knowledge about the prices of goods and services. They have a perfect knowledge about the prices of the input. However, they regulate the market. Another feature is large number of buyers and sellers. In a perfect competition where you have free entry and exit, of course you expect there to be large number of buyers and large number of sellers. The next is profit maximization objective. For every business organization, for every firm, it is one of their objective or aim or goal or vision to achieve profits. No firm wants to achieve loss. At no cost do we want to achieve loss. And we say an hypothetical example of a perfect competitive market is agricultural sector. Moving on, we'll be talking about a firm's demand curve in a perfect competitive market, and it says that the basic assumption is that all firms are price takers. When you say takers, it simply illustrates a scenario where they have no control over the prices of goods and services. As such, the interplay of forces of demand and supply fixes the price of goods and services. So the demand curve for this perfect competition market is perfectly elastic. That is, our price is constant and there's varying levels of quantity. Do you understand? So for any change in this price, for any increase in the price or decrease in the price, the consumer or the sellers are not or may not be willing to purchase. So what fixes the price is the interplay of demand and supply. However, for an industry's demand curve in a perfect competition market. Now, what do you understand by an industry? We say an industry is simply the conglomerate of firms, the merge, when you merge firms together to a single entity, then you're talking about an industry. Hence, we say an industry can influence the market prices by their collective actions. They can influence the market price, they can influence the quantity supplied to the market. However, we say the demand curve for an industry in a perfect competitive market is downward sloping because they can influence the price. They are the price makers. The equilibrium of a firm in the short run can be determined in two ways. However, I'd like to define the concept of short run, and I say short run is a period where some of the factors of productions are variable while others are fixed. Factors of productions, we have land, labor, capital, and entrepreneur. So some of them are variable while others are fixed. There are two ways to determine the equilibrium of a firm in the short run. We have the total revenue, total cost approach, and the marginal revenue, marginal cost approach. I'll be explaining this in details using their graphs. The total revenue total cost approach simply takes into consideration total revenue in terms of the accumulations of revenue received for the total product or quantity of product produced with respect to their prices. While total cost it simply takes into consideration the total cost of production used in the production process. On our y-axis here, we have the total revenue, total cost, and on the x-axis, we have quantity. Our total revenue curve is upward sloping from left to right, and we can see that it's a linear graph but upward sloping, and this shows that for an increase in the price with respect to quantity, it has a positive relationship. So when there's an increase in price, a rational seller will increase the quantity to get more revenue. As such, we have upward sloping total revenue curve. A total cost is simply represented with this graph, which shows the different costs incurred with different levels of output. So we say a point at which our total revenue is equal to our total cost is a point called the break-even point. And from this graph, we have 2 points where this meets. We have this point here and also this point. So at this point, we say it's a break-even point where the firm earns a normal profit. There is no profit, there is no loss. And as such, this point where we have a slight difference, that is, this point where our total revenue curve outweighs the total cost, is a point where the firm experiences or gains more profits with respect to the cost, and it is a point where they make economic profits. So, as an economist, I'd advise you as a firm or a business entity to produce goods and services at that point where you are going to make economic profits. Sounds cool, right? Yeah, that's why we're here. So, on moving on, we have a point where the total cost outweighs total revenue, and this is a point where you're incurring more costs with respect to your revenue. At this point, you're experiencing economic loss. However, it's not advisable to produce at this point. The second approach we have is the marginal revenue, marginal cost approach, and this is On our y-axis, we have the marginal revenue and marginal cost. On our x-axis, we have the outputs. And we say a point at which your marginal revenue is equals to your marginal cost is a break-even point. A marginal revenue, as we have said earlier, is perfectly elastic. That is, since our firms are price takers, they can't fix the prices of goods and services. The marginal revenue is equal to our demand. So for every additional increase in revenue with respect to changes in output, it is equals to the price. So our marginal revenue curve is linear, it's linear, and this is the graph here. What are marginal costs? This is the change in cost as a result of change in our output is U-shaped, but it's not even. However, it slopes upwards. So at the point where the marginal revenue is equals to marginal cost is called a break-even point, where your marginal revenue is equals to your marginal cost. And at this point, our firm experiences normal profits. But this point here, we can see that our marginal revenue curve is higher than the marginal cost curve. So we say the firm experiences economic profits. But this point where your marginal cost outweighs marginal revenue is where the firm experiences economic loss. So even as a layman, if I'm to ask you, at what point would you advise a business entity or a firm to produce goods and services? I'm very sure you would be able to answer that. So this simply shows the different approach we can use to calculate equilibrium in the short run. However, that being said, I'll be posting more videos, so I'd want you to like, comment, share, and subscribe to the channel, and also comment on the comment section for topics you'd like me to take and your remarks and contributions. Thank you very much. I remain your host, Miriam.